Hi, this is Lex, and welcome to the FinTech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and welcome to the podcast. I'm really excited about today's episode because we have with us our special guest, Will Beeson. Will is a close friend and, as you know, a co-founder of several neobanks in the B2B space, in the B2C space, and we're going to spend some time today unpacking what's happening in the markets and what's happening in the neobank theme as a whole. Will, welcome to the podcast.
Hey, Lex. Great to be back.
It's really my pleasure. So the market has obviously shifted quite a bit since we talked maybe, 2 years ago?
I think in our last conversation, we were wondering whether, I think it was like meme stock era, or maybe a little bit before meme stock era. And we were talking about whether kind of Chime, Robinhood, and maybe Cash App were ushering in a new era of consumer finance.
Unfortunately, in many ways, ushered out. So tell us a little bit about what's happened since we last talked. What does the world look like today?
Yeah, sure. So I think this will be a fun conversation. Hopefully, we can pull a bunch of different threads together in a cohesive way, which will make sense to the audience, because there are a few points here, and some of them are related. Lex, you're in my kind of traditional financial analyst training, how markets work, how cycles work, how institutional capital is allocated, and how that translates into stock prices. And then the other is our much more recent fintech and entrepreneurial experience, starting these things and thinking about the strategy and thinking about the unit economics and thinking about the business models and what we're learning about what works and what doesn't. So I think to answer your question, over the past probably 6 months or so, right, the writing was starting to appear on the walls in kind of November, December time. Largely speaking, it was inflation, and is it transitory? The prevailing view early on was yes, though there were some strong dissenting voices that it wasn't. With the eventual impact, if it proved to not be transitory, of rising interest rates, right? The Fed, and forgive me if I bring a U.S.-centric perspective to this conversation, we can open it up and try to make it as global as possible. The U.S. Fed raising interest rates, which did what that does, after a decade plus, maybe, of the lowest interest rates in history. And what it does is it changes the way the capital gets allocated. And it means that risk on investments become less attractive and safer investments start to become more attractive. It increases the cost of money, so speculation becomes more costly. What that did to the startup world, the early stage world, the Series A, B, C, growth, even, I suppose, publicly traded companies, software companies, growth as opposed to value. What that did is it certainly changes the modeling inputs. A higher discount rate equals lower present value of future cash flows.
That just shows that the world would be better without analysts, I think, without Excel files.
And at the same time, it meant that institutional capital started to get allocated to sectors that do better in down markets. So less sectors that are less highly correlated with consumer discretionary spending. And one of the points that I think I'll make throughout this conversation is that I think a lot of fintech is highly correlated with consumer discretionary. I think actually a lot of fintech is consumer discretionary.
The big tech companies certainly thought so. And a lot of the conversation early on about how fintech was this replacement of how you shop for financial products and where you get them was really targeted at people, at consumers. How can we be the Google of finance? It's painful to say that out loud now, but it was something that the neobanks and the robo-advisors and the paytech companies wanted to do. And I think there are probably still a bunch of founders who think that's a value proposition. And I think we've definitely seen through this market cycle exactly what you're saying, which is that a lot of the Silicon Valley stuff in terms of trying to build out fintech footprints is retail or is maybe small business and enterprise, right? And it swings around really harshly in a cycle.
Totally. I mean, I think if you think about the high-flying fintech stocks and also private companies, at least the consumer fintechs, Coinbase and Robinhood as two examples, they blew up when there was a high degree of demand for these risk-on assets that we were talking about, right? Free stock trading, especially using any sort of leverage, retail derivatives and options trading, and then same thing on the crypto side. When people have some extra money, and when people are feeling good about the forward-looking economic prospects, it's a lot easier to justify putting $100 or $1,000 or $10,000 into, like, putting a few chips on the table, right? Like to see if the thing that you're thinking about is going to hit it big. And it's a lot more difficult to do that, both psychologically and in terms of actual cash availability in a recessionary environment. So I think to that extent, there is a consumer discretionary element to certain fintechs.
What are your thoughts about the lockdown impact on the consumer, right? So we touched on meme stock and momentum, and there was, I thought, a really unexpected outcome in a lot of companies that were sort of grew much faster than anticipated during the lockdown. You would think that, you'd have a recession and the economy would contract and people would buy less stuff. But instead, there are a whole bunch of things from Peloton to Netflix to Amazon and all sorts of other things that powered the remote first lifestyle that had a fantastic boom period and are now broken on all of their projections. How did you think about COVID when it was happening as it related to these companies? I remember saying it's a permanent shift. It's accelerated the transition, and has it really?
During COVID, I can assure you that I was not, making any sort of lucid forecasts as to exactly how, specific companies or consumer trends were going to evolve. I think like most, it was kind of afraid for my life the first few months. But in retrospect, it turns out that stimulus checks are a powerful tool, in terms of consumer psychology and even the kind of economic details of how we avoided recession and how instead we ended up in this period of what appears to have been pretty meaningful overheating. I think it'll take years and deep analysis to understand all the various component parts. But to your point, we certainly did stay out of a recession, and to the contrary, it was a massive growth phase. I think in terms of, did it shift digital adoption meaningfully? Did it speed up the future? I'm still convinced that yes, it did. Find myself and those around me using a lot more technology on a much more regular basis than previously. I work remote now. I didn't work remote before the pandemic. I don't think I expect ever to be back in the office 5 days a week. And part of that might be personal choice. But the fact that I can, as an individual, make that choice is very different than the prevailing employment environment even a handful of years ago. So I think yes, in short, my view is that yes, it did accelerate the digital transition.
Yeah, I think there's a meaningful point here about teaching people behaviors versus people doing the behaviors, right? So there was definitely a spike in people working remote or people trading stocks or crypto assets or opening accounts in every payments app that you could to get the account opening reward, NFT drop, and so on and so forth. So there was a lot of behaviors that I think now are flat or maybe somewhat down if you look at the transaction volumes within fintech apps, but not drastically down. Like there's not a huge collapse of people doing digital financial behaviors. But separate and apart from that, I think it's really important that people have been taught how to do it. And that's permanent. So it's like, getting fit, right? If you don't work out for a while, you might not be as strong, but it'll be much faster for you to get fit again because you have that muscle memory. And so I think there's a built-in behavior shift now and a different set of norms because of that time period. Where are we now in terms of neobank footprints and the industry? How do you think about it?
We're all aware, right? Everyone's gotten crushed over the past 3 months now. Valuations have tanked tremendously. I know you wrote in your newsletter maybe earlier this week or late last week about something like a 90% valuation cut in, I think it was public market data that this specific A16Z report was looking at.
This was an appalling data point. I think a wild data point. It's hard to get into writing like the emotion about it because it's just, for somebody who builds in the space, it's so strange to see. I remember back in 2010 trying to raise money for a startup, and pre-money valuations on seed stage companies were 3 to 5 million if you were doing well. That's like a Y Combinator pre-money valuation. You're trying to raise 250K seed round. And then Andreessen and SoftBank and Tiger all came in and started exploding the amount of capital in the space. That turned into sort of a virtuous loop. The more capital there was, the more capital there was. And the more capital gains there was, the more there was raised, and that was invested. And then retail came in, and so on and so forth. I bet Google made a lot in advertising revenue for customer acquisition. The net effect of that is, if you look at pre-money seed rounds in the hot crypto or fintech companies maybe 6 months ago or 9 months ago, it's stuff like 50 million, 100 million pre for a seed round with like a $5 to $10 million check. I mean, just insane stuff. And the multiples on all these companies went from being something like 5 to 10 times revenue, which again, in 2010, 2015 would have felt like at 15 times revenue, you're a really valuable company, good for you, to SoftBank valuations, which is 100 times revenue if you have revenue at all. And I remember being very alarmed about those numbers, but then after a while, just kind of accepting that as like, here's where the market is. Why fight a good trend? And why try to call out SoftBank? And of course, we're on the other side of that journey, which is probably super painful for a number of people, where SoftBank lost $27 billion. I think Tiger lost $17 billion. They actually have to market, whereas Andreessen does not. The comps in the public markets on all the SPACs, from Dave to MoneyLion to even bigger companies like Block, all of that stuff is just down heavy on the multiple. And to me, the crazy thing is this: you're going from a 30 times revenue on average to like a 3 times revenue on average. And 3 times revenue on average is what you apply to sort of a core banking system from the 90s. It's what you apply to a laundromat. Like if you were to go about and buy a laundromat, you would pay 3 times revenue. So right now we're in a place where we're like, Coinbase is as valuable in terms of its revenue generation as your neighborhood laundromat. And I mean, to me, that just, I don't recommend people catch falling knives, but to me, that feels totally wrong.
Yeah, look, so my number one takeaway as a founder, as an entrepreneur, as an operator through all of this is there was a narrative that the fintech community was spinning for too long about how the unit economics will come, how the cross-selling will come, how we just need to like drive our wedge deep enough. And on this, super low margin / loss leader type initial product, once we hit the number of customers we need, it's more than 1 million, it's more than 10 million, but once we have 100 million customers, then it's going to be so obvious that the cross-sell opportunities are huge, that we, then like layer in lending and higher margin products, and kind of like to an extent, like an Uber type approach, like lose lots of money early on to establish yourself as the brand, build the network effects, and then everything's gravy. I think that narrative has not really been seen to fruition. I just haven't seen it playing out in the number of cases that I would have expected it to. And I think even if you look at mini neobanks, you mentioned Nubank before, which is perhaps something of an exception. I think they have meaningfully diversified product set, especially for a company that's relatively young in fintech.
It's a great business, and it has a prime market share position in a huge emerging economy. It's positioned so much better than a lot of the American stuff trying to replace payday lending. And still, Nubank has been absolutely hammered.
I guess highlighting an important point, I do think that there are 2 components. One is basically the market dynamics, like what happens when interest rates go up and what happens to institutional capital flows and the ultimate impact on growth, growth valuations and growth stocks. I think that's one thing which is impacting valuations. And I think another thing, which is perhaps more company specific, is basically execution against meaningful growth supported by strong unit economics. I think the market did not differentiate to a great degree in the boom times between businesses that had strong unit economics and that were growing fast versus businesses that did not have strong unit economics or didn't have them yet and we're growing fast. And I think that now there's a bit more discrimination among investors in terms of which type of company you are. Personally, I'm intrigued or surprised if I look at the leading neobanks in the US, the Chimes, the Varos, many others. I'm surprised that higher margin products haven't been meaningfully rolled out more quickly. If you think about lending specifically, certainly Chime's been talking about a credit card and potentially other lending products for a number of years now. I don't see it as a leading component of their product set at this point in time. Varo similarly has been kind of making the fintech newsletter rounds recently after someone dug up their Q1 bank regulatory filings about their monthly cost, cash burn and employee headcount numbers and profitability, CAC, LTV, stuff like that. Very interesting numbers, and look forward to, I think, June 30th. We should probably expect, or shortly thereafter, a Q2 update. But the amount of revenue generated through interchange and bank account fees is the vast majority of what Varo is generating. Their lending business is virtually non-existent, both from an asset standpoint and a revenue generation standpoint, which surprises me. They've had a banking license for more than a year. Don't get me wrong. I'm not saying it's easy to stand up a credit business. There are many, many, many component parts, and I think it's often the complexity is underestimated by many in the space. But nonetheless, there are 5,000 banks in the US, all of which lend.
I remember you and I had a conversation with Tinkoff Bank, which is the Russian version of Nubank. That asset is certainly not as valuable now as it was a couple of years ago either, but you could make the argument that valuations don't really matter if you have a cash flow generating profitable business. Because why does valuation matter? Well, it's because you want to pay your employees maybe, or maybe you want to go out and raise capital and you want your valuation.
Pay your employees in stock.
Yeah. You want free money so you can give it to people so that they stick around and they feel good about their life.
Or M&A.
Exactly. And why do you want to do M&A, right, is also to improve your competitive position. If you're in a bear market and everybody is barely surviving, just standing still, you will improve your competitive position because a lot of the things around you will just evaporate. And if you're cash flow positive and profitable, then valuation is just a number that wiggles around up and down. The thing that stuck with me from the Tinkoff conversation was that if it doesn't lend, it's not a bank. That lending is how you build a profitable depository business that is actually a financial services business. And I think when we talked to Starling, it was a similar point that a bank that's just trying to say, here's some prepaid cards and we get paid on your commerce, end of the day is not in the banking business. How do you think about profitability or stability of these companies? Like, do they have to go all the way into having lending's a big revenue stream? Are there any other ways to get around it? And how would you reflect on that statement?
I was reflecting recently, I think, seeing the kind of fintech disclaimer that all neobanks use now after this Chime settlement with, maybe it was the state of California, I can't remember, but where now every US neobank is a technology company, not a bank. Banking services provided by X bank, member FDIC. We are a technology company, not a bank, which is pretty interesting in the current context, because if you're a technology company and you have bank partners, then generally you participate in the interest income on the deposits that you're effectively gathering or brokering on behalf of that deposit taking institution. So I don't know, maybe you take 50%, maybe you take 80%, maybe you take 90%. It depends on the package economics of your relationship with your bank partner. But you definitely don't earn net interest. If you're not lending, like if you're not running a balance sheet, then there's no net interest margin component. And when interest rates are at all-time lows, sure, you're leaving some money on the table, but it's not as pronounced. In higher interest rate environments, banks start to print profit, right? They print money in all environments. They start to print profit during high interest rate environments because effectively the margin that they're able to earn between what they're charging on loans versus what they're paying on deposits expands, and they become more profitable. Fintechs don't have that opportunity. So this is not to say that you have to lend if you're a neobank. It's simply to say that there are now two strong motivations for doing so. One is that there's fee revenue attached, and two, you start to play more deeply in the sort of net interest margin type game. 3, I suppose you're also diversifying your product set with existing customers. You're going deeper in each relationship, so potentially there's a bit more stickiness that comes with that. I think we've been focused a lot so far in this conversation on neobanks and some stock trading, crypto trading apps, consumer fintech. Still in the consumer realm, but there's also the whole lending and buy now, pay later world.
I want to go into that, especially with some of the things you've just said, because it's really hard to win in the current market environment, even if you say, I'm going to repackage myself or position myself. I'm Varro and I'm running out of money because I spent it all on a license. And now I'm going to get into the lending business.
Everyone in fintech is always running out of money.
Yes, it is. Yes, absolutely. Everyone's always raising and everyone's always running out of money. But what I'm pointing to is that if you go and try to get the net interest income, then your revenues are definitely worth 1 to 3 times, because that's what a bank does. Your revenues are absolutely not worth 50 or 100 times. And so you deserve the 90% haircut. And certainly I think Square got that.
I think asking, though, the cynical, VC question now, having been watching, what's played out for the past 10 plus years, if you're a technology company and not a bank, but your software allows people to make deposits and transact on a debit card and do the banking stuff without the balance sheet, is that worth 50 to 100x revenue multiple?
Only if you're a distributor with an 80% market share, like some of the big tech companies.
From a SaaS standpoint, you build one piece of software one time and then you sell it to as many people as you can. You invest some to maintain it and you invest some to host it. But it's ultimately like a sales subscription game. You're just scaling the sales of a single piece of software. It's pretty clear in that scenario why, if you're a piece of software and not a capital intensive business, therefore your revenue is infinitely scalable through your sales activities, why that is a 50 to 100x revenue business as opposed to a 1 to 3x or 3 to 5 or whatever it is. I think if we really look at ourselves in the mirror now and go deep on a lot of these fintechs that we've been very excited about for many years and continue to be very excited about, I think we need a clear financial story as to why, if you're a software company and not a regulated financial services business, but your software facilitates this consumer finance need, why that justifies the difference between the 1 to 3x revenue multiple if you're quote unquote in the banking business, and a 50 to 100x multiple if you're quote unquote a tech company.
Yeah, I think that's fair. The final sin of it is digital lenders, and actually anything that has to do with underwriting has done the absolute worst in the current environment, because there's not one market. There's the private market and the public market, right? In the public markets, bank analysts have a very good sense of credit books and what it means to underwrite and the difference between revenue and insurance premiums. Something like if 95% of your premiums are meant to be just like float, they're meant to go away, maybe your revenue is only 5% and not the whole 100%, right? So if you look at things like Lemonade, one of the sort of favorite insurtechs out there, or if you look in the digital lending space, in the pure digital lending space, not even buy now, pay later, which we'll get to in a second, at things like Lending Club and Upstart and whatever remains of On Deck within Innova, that is a place where I think there's a continued valuation misunderstanding and gap between venture investors and public analysts. Because venture investors just put SaaS multiples on underwriting revenue with the intent of in 5 years, we'll be out of this company anyway, and it will float on the markets and whatever. But what happens in 5 years to your underwriting revenue is that you get hit with defaults on the other end. And so you actually don't know how much you've made until you have to absorb the losses on your balance sheet. And so it's been a bummer, I'll put it into a technical term, to see really interesting companies that are using, machine learning, that are using new types of data sources, that are going after people who are underbanked and often have a fruitful social mission to get rid of payday lending, to experience really negative economic conditions as a result of people sort of not connecting these dots and expecting different results.
Totally. And then I think by extension, buy now, pay later, the space that we've seen really boom over the past few years, in part, I think looping back to an earlier point in the conversation because of consumer spending behavior during the pandemic, right? All consumption is now online. I think a lot of the valuation pressure there is everything you just described. And also, the simple fact that none of these companies, which were founded in the past few years, have been through a full credit cycle. Now, it will be interesting with the very recent news of the Apple Pay Later, I think is kind of at least the colloquial terminology for it. Basically, Apple's Buy Now, Pay Later offering attached to Apple Pay announced, I think, just this week. It'll be interesting to see the impact that has on the fintech Buy Now, Pay Later space. I think on the day it was announced, maybe Afterpay, maybe Affirm were down something like 10%. I think PayPal ended the day flat after selling off initially on the news. But it'll be interesting to see whether Buy Now, Pay Later continues to be a sector or whether it evolves, like I would argue robo-advisory evolved into a feature, kind of like a free feature as part of the experience. You're actually kind of paying for something adjacent. In the case of Apple, you're paying for the iPhone, or you're paying for whatever you have to be buying at the point of sale. And Apple's earning money on the payment revenue. And the Buy Now, Pay Later is just kind of added on for free, right? It's an opportunity, for you, the consumer, to have a more seamless, consumer-friendly experience. It'll be interesting to see how much evolution there is of the Buy Now, Pay Later space in that direction versus the verticalized, product-focused, product incarnation that we see now.
To be fair, I think the more of finance that can be boiled down into a feature and given away for free, the better.
100%.
Because at the end of the day, this stuff it's not worth defending. It's there so that people can live their lives and get the things that they actually need, not sort of play around with structured derivatives and figure out the best way to arbitrage stuff. But the Apple news is really interesting, and in particular because I think this theme of big tech entering finance and kind of scaring all the JP Morgans and Citis and Wells Fargos of the world, it's kind of an old idea. It's, 5-year-old idea now, and it didn't materialize in the way that I think a lot of people expected. And so now it's almost cliche to bring up big tech as a threat to finance because that hasn't really happened. And Google and Google Pay are often the example of that flop because they've tried to do a neobank that didn't quite work out. They've repackaged it, or like Google Pay is not really at huge scale. And so they've shut down Google Finance, I think, a number of times. And it doesn't feel like the tech firms are interested in, like you say, capital-intensive business. But we looked at the Apple Pay numbers recently, and it is massive. It is gigantic. I think it's something like more than 500 million users of Apple Pay. And I think, to me, like, I look at Apple and I look at Google and I try to think about why did one work more so than the other? Or, you look at PayPal's growth and you look at Apple Pay's growth and you try to make sense of it. And for me, I think it comes down to merchant adoption and the fact that proximity payments, so paying with your phone or contactless cards or whatever, is still much, much bigger than e-commerce. And so Apple kind of grew into this gigantic space and was able to use its weight to change consumer behavior, to really change consumer behavior. And I don't think any app that's a feature inside of another company's phone is able to change consumer behavior. So while a lot of folks, I think, are sort of skeptical of Apple's entry doing damage to the Klarnas and Squares and so on of the world, I do feel like they will, at the least, take market share, meaningful market share from them.
Yeah. I mean, you talk about the difference between Apple Pay and Google Pay. I'm certainly not an Android expert. I have an Android device that I use for a few kind of work-related app testing type things. And I think, simply put, it's the depth of integration of Apple Pay into the Apple experience. I think a lot of what has made Apple strong, right? It's like once you're in the ecosystem, then you're in the ecosystem, and it's a component of Apple which is just built in. When I browse a website and go to make a purchase, Apple Pay automatically pops up. Like, it's, as long as I've loaded my card, it's right there, and it's easy to use, and it's a joyful experience as a consumer. And I think over time, right? Because Apple Pay is not brand new.
In
fact,
slog, yeah.
I think if we'd been having this conversation a couple years ago, we'd be talking about how Apple Pay had not had not really caught on, right? Like the way that people were expecting it to. And interestingly, you talk about FANG in general in financial services, and I think the companies that are doing it well. I think Apple's a tremendous example. I also think Square is a tremendous example. Are taking a very long-term view of how these pieces fit together, and where value creation comes from over time. And it's less about raising a splashy round and trying to deliver something in 6 months. It's more about slowly impacting consumer behavior, investing in a few kind of long burn components that can be stitched together later in time once they've started to reach maturity. I simply haven't had the same intuitive and joyful experience with any sort of Android or Google Pay type device. And in fact, it's still unclear to me, again, as a non-regular Android user, but I hear about there's Samsung Pay, there's Google Pay, which is which? Do I have to install one or the other? Whereas Apple owning the OS, owning the apps that ship on your phone. I appreciate this is a subject of a judicial review at this point in time, but nonetheless, it has been a very effective way of making it clear to users what you're supposed to do, how you're supposed to do it, and where to find the button that makes it happen.
Yeah, Europe is not so fond of monopolies, and now Apple Pay is now successful enough to be a monopoly. So we got to wrap up, but I want to ask you one last question, which is, neobanks and kind of pay tech inside and out. We're in this bear market environment. We're probably going to see a recession with consumer spending a lot less. Valuations are going to be tighter. What and how should somebody who believes in the sector do when they're trying to build a business now? Like, how should somebody's mental model change, and what should they adjust as they make things?
Sure. Well, if you read the A16Z report, they say that if valuation multiples of revenue fall from whatever it is, 100 times to 15 times, and you as a software company earn 20 million ARR, then the answer is to increase your ARR to 133 million.
Yeah, that's great.
Problem solved. That way you don't have to lower your valuation for your next fundraise.
From Andreessen. Yeah.
But joking aside, I want to take that question, use it as an opportunity to talk about why I'm excited right now. Because we've had a relatively pessimistic conversation, right? Like the challenges with neobanks, the challenges with consumer fintech, the challenges with where's the opportunity, where's the positivity. I mean, look, to answer your question, there is definitely pain here. We've experienced pain over the past few months, and there's more pain to be experienced. And of course, it's terrible when it affects specific individuals at a human level. But from an ecosystem standpoint, it's also hugely healthy to reset valuations, to shift focus on fundamentals, on unit economics, on thoughtful strategy, which goes over and above how do we spend $100 million in TV and tube ads and get as many customers as we can. I think the best companies are founded and built in hard times. If you build a company, if you design a business model, if you design operating model, if you design economics, and you raise money from scrutinizing investors during a difficult period of time, that company is much more likely to be successful in any economic conditions, much more than the more opportunistic, speculative company that's designed to work in boom times. Now, innovation definitely comes from both places, but I think potentially some real enduring change for this industry will be both created during and also kind of honed and enhanced through what may be a bullish period.
That's fantastic advice. And
bearish period.
Yeah. First bearish, then bullish. Will, it's been fantastic to have you on the podcast. If people want to learn more about what you're doing and get in touch, where should they go?
They can look for me wherever they want. Twitter, Will_Beeson, LinkedIn, or rebank.cc, where I do some content of my own.
Fantastic. Thanks so much for joining us today.
Thanks, Lex.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.